Good evening, ladies and gentlemen. This is USA Trading Frank. Today is March 26, 2017, approximately 7:06 p.m. Eastern Standard Time, Sunday evening. And futures have started trading about an hour ago. We're showing down roughly 14 points. I'm going to walk people through specifically technicals today and give my comments, what I think might be going on. Strategic forecasting for the coming week, going into the end of the quarter, first quarter 2017, which ends on March 31st. There's exactly 5 trading days left. Will be extremely dicey, to say the least. As I'm going to walk through people through charts, you're going to see, and I'm going to try to keep this as simple as possible, that it's critically important, and I cannot even emphasize how critically important it is that the technical factors and the tactical trading aspect of the market, which I keep on hammering on all the time, is of prime importance for effective trade management. Selective trades are important, as you can clearly see what we've been doing via the real-time Twitter feed, the trade alerts, the real-time Periscope broadcasts, and comments, that we have had some extraordinary success in the markets, despite some extremely volatile, to say the least, markets. As you know, via my on my service, on the USA Trading service, you all know by now, and a lot of the newer members are starting to see that clearly, that every single day I am producing content that can be used effectively, even though the intraday movements in the market are extremely volatile, what I call sudden impulse surges or pump and dump algo HFT programs that completely dominate the marketplace during trading hours and after trading hours. And despite all that, we have had some huge successes in multiple fronts on individual stocks, from tactical lows to tactical highs, and on the SPX, on the RUT, both on the long side and the short side. So the key is, and I really want to keep this very straightforward, that if you're not watching charts, if you're not understanding what's going on with my delivery of charts based on the Think or Swim platform that you're looking at right now, or the Quad Algo HFT platform that triggers off the buy signals and the sell signals to a very, very high degree, the candle reversals, the hammer reversals, the inverted hammers, and all those very specific alerts, and you don't have access to charts, or you're not bothered to look at charts while you're trading, you're simply looking at prices, you will have a very high probability of getting hurt, giving back large profits, incurring losses at the wrong time, staying emotional, fearful, or maybe getting a little too euphoric when the prices are running, not selling because you're feeling a little bit too good about your P&L, and I'm just trying to help. Okay, you keep on doing that stuff, you're just not going to get anywhere. So the point is, a couple of extremely simple rules to follow. Keep trade sizes small. Act quickly if you have profits based on the tactical levels that have been shown. Be ready for very, very fast, and I mean really fast. You're talking seconds, because algos and these high-frequency trading programs that are run via black boxes, algorithmic programs, these move within split seconds, if not nanoseconds. I try to detect the levels prior to that, and as you all very well know, that I've been very successful in identifying those levels, and once they get there, I tend to, or get close to that level, whether it be on the high end or the low end, I tend to react rather quickly. Now, that doesn't mean you have to be a MOHTR, which is a monkey on a hot tin roof type of trader, but it is extremely important to keep a keen eye on the SPX, ESF, which is the E-minis, the Russell 2000, the TF, the Russell 2000 futures, the VIX chart, and all those very, very precise tactical charts that I'm putting in through my hard work to help everyone navigate their trading profits and their trading book, basically. If you're a swing trader, you still got to keep an eye on them here and there. I do realize a lot of people have full-time jobs, obviously, and keep your daytime jobs, please, till you think that you're ready enough to handle the high-stress situation and the high-profitable situations of being a professional trader. Like I've said, and I mean that in all humility, if I can do it, Many of you can. Okay? But it takes hard work, it takes discipline, it takes focus, it takes brain cells. And it takes guts. So it's a combination of all that kind of stuff. So, coming down to it, you got to keep an eye on the charts. Without the charts, you're not going to be able to navigate the markets. Period. That's it. There's no straight line up. There's no straight line down. There is only tactical levels that you can trade off. And of course, on some of the swing positions that we sit on, those things, of course, you don't really care if they go up or down on a certain day. You want to, unless there's a real trend change. In that case, you know, you're obviously looking at a different situation. In that case, you want to dump that long-term position and move on. So saying all that, futures are down about 16 points now, 15.5, and I'll tell you, it's going to be one heck of a hairy ride when we wake up in the morning. It is a hairy ride right now, after hours. And let me walk you through some very simple stuff that you have to keep an eye on, and we'll move from there. So here we are. I'm going to start off from the elections, okay? I'm going to actually start off from Brexit. So where's my drawing tool? So for a lot of new members who have a chance to review the old video cast, this is a repeat of that, but I'd like to remind everyone, because to understand the history is to understand what pattern, symmetry, and what kind of things can repeat itself. Because human behavior, which is reflected in the form of charts. Charts are nothing but basically machines, and human behavior of fear and greed do tend to repeat themselves, even though nowadays the forms get very convoluted. So saying all that, here was Brexit. The war was going to end, and all kinds of stuff back in June of last year. If you'll remember, we had almost 800, not 800. I think it was a yeah. I believe it was almost an 800-point drop, and then it turned around and fast forwarded out. Oops. I guess that's the zoom function. Bear with me 1 second while I try to fix that. And I fixed it. Good. You know, I guess I'm getting smarter. So, so saying all that, here was your Brexit. Big move up. Oh boy, starting to do this again. Let me see if I can do this right. All right. So here we are from Brexit. Then we had a sudden collapse back in that August-September time frame, where we always have some sort of substantial pullback. It also happened in October. And that's exactly what happened in October. We had 9 days of consistent selling, and then comes elections. We dropped about 1,000 points on the Dow after hours. Kind of going fast forward on this stuff, and then after that, it's been one heck of a rally. Now, this has not been a straight line. So anybody who tells you that the market's on a straight line up is a complete liar. And you hear that in the media. You hear that from a whole bunch of analysts. You hear that from traders. Okay, bearish traders will always tell you, the dogmatically bearish bears will always keep on telling you that the market just goes up in a straight line. The market never goes up in a straight line. Okay, get that through your head. As a trader, the market goes in waves. And in hindsight, when we're studying all this stuff, it looks pretty easy because in hindsight, everything's 2020. Oh, it went up, you know, and then traders lie. Oh, I bought it here and I held it all the way here. They're all complete lies. Okay. The most professional traders, I should say the most diligent and the more consistent traders, and I like to say I'm one of them, or basically take profits on a staggered basis, watch for tactical pullbacks, and things of that sort. Not always exactly right, but majority of the time I am correct in what I'm doing. And I'm, again, no fluff here, straightforward talk. So saying all that, you can see here that this has not been a straight line up. It's basically been movements up. Sorry about that stuff. Okay. So, and then you get consolidations. You get consolidation here. I really, really do apologize for this because there's something, you know, it's just. All right, let's see here. To get that, you get consolidation. Oh boy. Okay, at least we're seeing a close-up view. Okay, I am going to do something here, guys, so I do apologize for that in real time. It has to do with changing a function, which I really don't want to do in the middle of the thing here. So I'm just going to show you. So you get these consolidation moves, which, you know, could be 100 points, could be 200 points. Everyone freaks out. I walk people through. The room goes dead silent. natural, reaction, standard reactions from, human traders. And then the market moves sideways, takes off, and then we get this big, huge moves up where it looks like it's just going to go to the moon, right? No pun intended. And then comes this big consolidation move, pullback moves, which again don't happen in one straight line. These are pretty powerful swings. You can see it's a wave pattern that's being played out. It's not a straight line from 2400 down to the 2300 level, which I think we're going to at this point before we have a very sharp bounce, or we might hold one of these levels that I'm going to explain right now. So again, and in between all this stuff, we have had fantastic wins. Even last week turned out to be a solid week, despite the fact that this particular movement here that suddenly appeared from nowhere at around 9:46 a.m. on last Tuesday. Let me get to that quickly. This move, for example, that started at, it says 9 here, but it started obviously after the market opened. We sold a whole bunch of stuff. I saw a naked bar spinning top. I did not realize that we were going to have a 200 plus point down day. But I should have reacted on that. No question about that, because it was a naked bar spinning top, but there have been many, many times that we have had that, and that simply means that all of a sudden, it just drops in thin air. So that's how markets, it's also known as a bull trap, and these machines do it so fast these days that unless you are reacting to it right away, holding your nose, because this might look like a straight line down, but it wasn't like that at the time it was going on. There was a lot of little zigzags along the way. The market's trying to bounce off certain levels before it actually showed like this and ended the day on Wednesday. So on Tuesday when the market closed. So bottom line is that these type of things in bull market generally don't manifest themselves into big 200-300 point drops. That's this reversal inverted hammer type of thing. But it did. Saying all that, we played the reversal and the basing pattern like a fine piano, like a fine violin, okay? And we did extremely well. It went up, it hit these levels, and again, I'm showing you the basic version on the Think or Swim charts. The specific versions are on investing.com and on the quad and on the shorter term time frames of these particular charts. I've walked people through it every single day, every 15 minutes or half an hour, and you all know what I'm talking about. So here we are. Here we are, and this was the close on Friday, where we had a big hammer reversal. You can see that right there. Okay, look at a little Chinese firecracker, long tail with a firecracker head on the top, and now here we are dropping off hard. And we're going to go into another screen so I can show you dropping off hard. Futures down about 15 points. As I mentioned on my last tweet, that foreign markets react negatively to this pretty immense defeat and the first political defeat on, for if you want to look at it that way, by the new Trump administrations, who are being so business friendly, so helpful to the markets, and obviously the markets, global markets, are going to be somewhat disappointed. Individual sectors are going to act on their own volition. I believe the healthcare sector is going to breathe a sigh of relief. Because there are not going to be heavy funds that are going to be cut off from that side, because whatever this ACA or Obamacare, whatever you call it, it has pushed a large number of dollars into hospitals, and drug companies have been able to basically benefit off that with their loose price controls and stuff like that. So I think the healthcare is going to be a short-term beneficiary of what happened, and we saw that reaction on the markets on Friday. So saying all that, we are right now, and this is extremely important, and I'm highlighting it from election day, okay, November 9th, the day after the election, and this is where we are. Now, this is a critical point here. In very simple terms, we are attacking the 50-day moving average, period. The 50-day moving average, as you can clearly see here, is still moving higher. So looking at this here, the 50 and the 34, which is this orange line, as I always depict the 34-day moving average, which I use extensively, is in orange, the 50 in red, and the yellow line is basically the 5 SMA, the trader's buddy, if you want to call it, you know, that short-term trend movements. So if you can clearly see here, the 34 and the 50 are still, you know, nice spread here, and it's still moving higher. There hasn't been any break whatsoever. Now here is the thing that I've learned over the years. You will not see the 50 and the 34 just keep on turned down just like that in a matter of a day, because that's why they're 34 and 50-day moving averages, right? If you understand what a moving average is, it's the prices averaged out over 34 days and the prices averaged out over 50 days. So in order for these lines, by the time that they actually turn down, which means this onset of a short-term bear market, I apologize for the zoom function again, then by that time it's too late. So at this point in time, monitoring the 5 SMA is important, and the 5 SMA is pointing down. It has acted as resistance since the 21st. It's actually acted as resistance, I would say, since it broke below that on the 20th, March 20th, right there, right? You see that red candle? So at this point in time, a breach of the 50-day moving average, these are the levels that I think the market can go to. Now, once the market breaches or breaks below the 50-day moving average, you're going to hear the primal yell of the dogmatic bears. You're going to say, this is it. This is the start of the big, huge drop in the market. This is the bear market starting, and all that type of stuff. I'm not going to say it's not garbage, but I don't see a bear market starting. Bear markets don't start from strong economic numbers. Bear markets don't start because the new president had one political defeat on passing repealing the healthcare bill. A bear market doesn't start with interest rates at historical lows. Okay, period. So these are things that some of you who've been in the market, you know, probably understand that, or are students of market history. So at this point in time, this was the breakout level, and I've showed this. I've showed this repeatedly. I have 3 minutes left in this video. I'll be continuing this on the next video. So just, you know, just keep that in mind. So at this time, 2300, as you can clearly see, seems to be a logical place where the market can come down to. And it'll be a break of the 50-day moving average, but not the end of the world. You're going to hear a lot of that in the media. I'm warning you. You're going to hear a lot of that from your buddies. You're going to hear a lot of that on stock twits and many other trading forums. They're all going to be talking about the same thing. That's it. It's the end of the market and all kinds of stuff. They missed out the entire rally since 2009. I still believe that more than 80 to 90% of traders in general have been shorting the market or not participating in the market. Forget about mom and pop. They're just not in the market. They just started coming in. So the bottom line is that they're always hoping that the market basically crash and burn. And when they does, and the markets do correct 8-10%, and we have seen a few of those, okay? 4-6%, 8%, 10% correction are very rare. There's nobody in sight to buy them. So I just don't get it. Anyway, I give up. So the bottom line is that the 50 is important, but just because it breaks doesn't mean it's the end of the world. In fact, I'll be a pretty large buyer, aggressive buyer of the market at the 2300 level. So this is what's going on after hours. We're pushing hard down 50. I mean, down 15 S&P handles, E-minis, and the bottom line is that at this point, this particular, let me see if I have time to do this. Yeah, I have a minute and a half. I would say that this is a very strong possibility. Now, will this happen right away? I don't know. I'll explain something on the next video which says that the next 5 days are also very critical because it's the end of the quarter. And all kinds of funky stuff happen at the end of the quarter because the people who manage the real money, the mutual fund, the 800-pound gorilla in the market, trillions and trillions of dollars, the smaller players, the hedge funds, the pension funds, which are another very large player, they are probably not going to just dump everything just because they're not feeling too good about the market. They do it slowly. Whichever the case, I'm going to be continuing with these charts in the next video, but keep in mind that that's where we are right now, resting exactly at the 50-day moving average. Pretty monumental. The last time we touched the 50-day moving average was close to it, but we never really touched it. And we got close to it. We basically kept on bouncing off the 34 SMA. Let me move on to the next video, continuation of this one. Stay patient.